If we're watching markets during a war and thinking, what are we supposed to do right now? That's normal. This is the moment when the brain starts demanding action. It wants to sell, buy, hedge, chase oil, chase gold, do something, anything, so it feels in control. That urge is the biggest danger, not because we're weak, but because uncertainty makes humans crave certainty, and markets don't offer it on demand. We're going to keep this simple. This is a one-plan playbook for war headlines, market crashes, and scary volatility. It's not about predicting the next move, it's about protecting ourselves from panic decisions, keeping our cash flow stable, and making sure we don't destroy years of progress in a single emotional week. I'm Carlo. We spend way too much time thinking about money, behavior, and how regular people can do the right thing without needing to become market experts. And here's the truth. Most people don't lose long term because they picked the wrong ETF. They lose because they react at the wrong time, with the wrong money, for the wrong reason. Before the steps, one reality check. During geopolitical shocks, markets often do a few predictable things. Volatility rises, risk assets can sell off, energy prices can spike if supply or shipping risk increases, and people start searching for safe places to hide. The details change every time. The headline changes every hour. That's why our plan has to be process-based, not forecast-based. We're building a system that works whether the market drops 5% or 25%, whether oil spikes or settles, and whether the news stays intense for a week or a year. Here's the only plan that we need. It has 5 parts. Number 1, stabilize our real life first. That's cash flow plus the emergency fund. Number 2, stop making headline trades. Number 3, decide based on the time horizon. Number 4, use a simple portfolio rule. Number 5, keep buying on schedule if we're long-term investors. That's it. Now we walk through it step by step, and we'll add real examples and rules we can actually follow. Step 1, stabilize real life before we touch the portfolio. When war is in the news, the biggest danger is in the market itself. The biggest danger is being forced to sell at a bad time because real life needs cash. If we don't have a buffer, a market drop doesn't just hurt on paper. It becomes a real financial problem. That's why our first step is personal, not market related. We want to answer one question. If income drops or expenses spike, how many months can we cover essentials without selling investments? Essentials means housing, utilities, basic food, transport, insurance, and minimum debt payments. No vacation, no upgrades, no nice to have, just survival costs. If our runway is less than 1 month, the plan is simple. We build a buffer before we do anything fancy. We don't need a perfect emergency fund overnight. We need enough cash to avoid panic decisions. Beginner targets that work, a starter buffer of $1,000 or your local equivalent. Next target is 1 month of essentials, then 3 months, and if income is unstable, build towards 6 months. This is the difference between investors who can wait and investors who get forced out. A crash doesn't ruin us if we can wait. A crash ruins us if we have to sell. If we're carrying credit card debt at 18 to 30%, we're paying a guaranteed loss while hoping the market gives us a gain. That's backwards in normal times, and it's worse during crisis because stress makes people do impulsive things. So if we have high interest debt, the plan becomes minimum payments always, no missed payments, extra money attacks the highest interest first. We invest only what we can truly keep invested. We are not saying never invest. We are saying don't pretend we can build wealth while bleeding 22% interest. Paying off high interest debt is one of the cleanest financial wins available because it removes a guaranteed cost. Volatility creates late night decision making. That's where the damage happens. We set guardrails now while we're calm so we don't negotiate with ourselves later. 2 rules that protect most beginners. 1, we do not sell long-term investments to fund short-term fears. Number 2, we do not buy risky assets with money we might need within 12 months. If we can follow those 2 rules, we're already ahead of most people. War and uncertainty can affect jobs, prices, and costs. We don't need to predict exactly how. We just need to assess our vulnerability. Ask, is our income stable or volatile? Could we replace our income quickly if we had to? Are we supporting other people? Are our expenses flexible, or are we locked into big monthly payments? Then ask one more important question. Do we have a cost spike category right now? In war-driven markets, energy prices can rise, which can show up as higher gas, heating, transportation, or food costs. If we're already tight, we need to create margin, not by trading, by reducing optional spending and building buffer. If prices rise and our margin is zero, the stress goes up. When the stress goes up, investing mistakes increase. We're trying to avoid that chain reaction. When war escalates, the internet fills up with urgent advice. Buy oil, short stocks, buy gold, buy defense, sell everything. This time is different. Some of those trades might work short term, many won't. But the bigger issue is that most people aren't building for trading. Trading requires risk controls, position sizing, stop rules, and emotional discipline. Most beginners do not have that, and that is fine. We are building wealth, not trying to win a weekly prediction contest. So here's the rule. We don't change our plan based on a headline. We only change our plan if our personal situation changed or our portfolio drifted away from our target. That's the filter. Did our income change? Did our expenses change? Did our portfolio drift far from our target allocation? If the answer is no, we don't do something just to feel in control. Why headline trading is dangerous? Headline trading feels smart because it sounds connected to the real world, but it usually fails for three reasons. First, markets often price fear quickly. By the time we react, we're late. Second, we tend to buy what already went up and sell what already went down. Third, we create a new problem. We must decide when to exit. Selling is one decision, buying back is another. Most people sell because fear is high, then wait to buy back until things feel safe, which is usually after prices recovered. That is how panic becomes permanent underperformance. So if we want one simple mindset, our job is not to predict. Our job is to avoid doing the dumb thing. Step 3, decide everything based on time horizon. This is where we regain control because what should we do depends on when we need the money. There are only 3 types of money. If we need money within a year, it should not be in volatile assets. During crisis-driven volatility, stocks can drop quickly. If we're forced to sell to pay rent or handle a repair, we lock in losses. So short-term money goes to cash-like options. The goal is stability, not maximum return. This is where people make the most mistakes. They invest down payments and near-term goals in stocks because stocks go up. The problem isn't long-term expected return. The problem is the deadline. If markets are down when we need the money, we cannot wait for recovery. For 1 to 5 year goals, we choose a conservative approach and accept reliability matters more than chasing extra return. This is long-term investing money. If our time horizon is long, we don't panic sell, we keep buying. The reason is simple. The market's short-term path is unpredictable, but long-term ownership of diversified assets has historically had positive expected return over long horizons. That does not mean it goes up smoothly. It means our time is our advantage. Long-term investing only works if we can stay invested. That loops back to step 1, cash buffer and stable cash flow. Step 4, use a simple portfolio rule. Rebalance, don't guess. This is the part that turns chaos into a system. We choose a target allocation based on our horizon and psychology. It can be as simple as 80 and 20, stocks and bonds, more aggressive, 70 and 30, moderate, 60 and 40, more conservative. We don't need the perfect mix. We need a mix we can stick to during a drawdown. Here's a simple test. If a 20% portfolio drop would cause us to sell, our stock allocation is probably too high. A plan that matches our psychology is more valuable than a theoretical optimal plan we abandon. War headlines can cause stocks to drop, safe assets to move, and sectors to swing. Our portfolio drifts away from our target. Rebalancing means we bring it back. We don't do it daily. We do it on a schedule that's monthly or quarterly, or when the portfolio drifts beyond a band, for example, 5% off target. For example, if our target is 70 and 30 and stocks drop so we become 62 and 38, we buy stocks to move back towards 70 and 30. That feels uncomfortable, but it's disciplined. It's not guessing, it's math. If rebalancing feels complicated, we can simplify by using fewer holdings or a diversified all-in-one approach, depending on what's available to us. The goal is to reduce decision-making under stress. Rebalancing is small and rule-based. Panic pivoting is we're going to all cash or we're going all in on oil. One is disciplined, maintenance. The other is emotional forecasting. Step 5, keep buying on schedule, especially during volatility. This is the wealth builder. It also feels hardest emotionally. If we invest for the long term, we set up automatic investing each paycheck or month, and we don't stop because the news is scary. We do not need to call the bottom. We need consistency. When markets drop, our normal conditions buy more shares. When markets recover, those shares compound. If we stop buying during declines, we often miss the future gains that come after fear peaks. A simple rule we can follow: keep the normal schedule. We don't increase risk because we feel brave, and we don't stop because we feel scared. We let the system run. If we want an optional rule, we can add a small, systematic volatility add-on, but only if we can afford it. For example, if markets drop 10% or more from recent highs, we add one extra contribution equal to one normal monthly contribution. This is optional. The default is consistency. The war and crash checklist. When headlines hit and the market drops, we run this checklist. First, are bills covered for the next month? Then, do we have a starter buffer? Third, are we adding high-interest debt? Fourth, is our long-term plan still valid? Fifth, is our portfolio off-target enough to rebalance? Sixth, are our automatic contributions still running? 7, are we about to make a decision because of fear or because of a rule? If we can answer these honestly, we can avoid most big mistakes. But Carlo, what about oil, gold, and defense stocks? Good question. This is where beginners get pulled into war trades because, well, let's keep it simple and honest. Yes, war can impact energy prices. If supply or shipping risk increases, oil can spike. That can spill into inflation expectations and costs in real life. Certain sectors can benefit, but the question is not what can move. The question is, what should we do with this information as beginners? Option 1 is to do nothing special. If we own diversified funds, we already have exposure to energy and to companies that react in different ways. We don't need to guess the perfect war winner. Option 2, a tiny sandbox if we truly need it. If we absolutely want to express a view and keep it small, 1% to 5% max. We treat it as speculation. We accept we could be wrong. We don't let it replace the boring core. Most people mess this up by turning a small view into a core plan. That's how they blow themselves up. Option 3, focus on inflation response in real life, not trading. If energy prices rise, we may face higher gas and food costs. The best move isn't necessarily trading oil. The best move is preserving margin. Reduce optional spending, avoid new monthly commitments, and increase cash buffer. That improves our financial position immediately without forecasting. 4 extra rules that matter in wartime markets. Leverage means borrowing to invest. It magnifies gains, but also magnifies losses. In crisis volatility, leverage is how people get forced liquidations at the worst times. Beginners should avoid it. We build wealth with consistency, not with margin calls. During conflict, obvious trades feel safe. Oil is up, so buy oil. Defense spending might rise, so buy defense. The problem is, if it feels obvious, it is often already priced in. Also, concentration increases regret risk. A diversified plan reduces the chance that one wrong guess ruins our timeline. Short content is designed to trigger action. Markets punish impulsive action. If we are changing a multi-year plan because of a short clip, we're doing it backward. We only make changes after we run the checklist, and we can explain the change in one calm paragraph. If your portfolio is preventing you from sleeping, it's too aggressive. That's not a weakness. That's a signal. Sleep matters because exhausted people make worse decisions. If we need to reduce risk a little to stay consistent, that's usually better than staying aggressive and panic selling later. 3 real-world scenarios and what we do. We do not sell. We check our buffer and cash flow. If bills are covered and we have at least a starter buffer, we keep automatic investing on. If we have extra cash we truly don't need, we can add a little, but we don't have to. The plan is to keep the pipeline running. We stop trying to do everything at once. We invest enough to get an employer match if available. Then, we focus heavily on killing high-interest debt. Once debt is under control, we scale investing again. This is how we stop fighting ourselves. We pause and run the checklist. The urge to go to cash usually happens after prices are already dropped. If we sell now, we lock in losses and create a second decision. When to buy back? Most people buy back late. Instead of selling everything, we do safer moves. Increase cash buffer if it's low, reduce optional spending to create margin, rebalance if needed, keep contributions running. That gives us control without wrecking the long-term plan. The if-then decision tree. Use this when we feel the urge to act. If we might need money in the next 12 months, then keep it in cash-like instruments, not stocks. If we have high-interest debt, then pay it down before increasing investing. If we have no emergency fund, then build a starter buffer before doing anything fancy. If we are long-term investors and diversified, then keep buying on schedule. If our portfolio drifted far from target, then rebalance. If our plan hasn't changed, then do nothing extra and let the system run. If we feel a strong urge to trade, then wait 24 hours and reread the checklist. That last one matters. A 24-hour delay prevents emotional trades. The don't get cute section. Mistake number 1, selling to wait for clarity. Clarity usually arrives after prices recover. Selling to wait for clarity is how people sell low and buy high. Mistake number 2, doubling risk because it's cheap. If we take on more risk than we can handle emotionally, we will sell at the worst time. Better to be slightly conservative and consistent than aggressive and inconsistent. Mistake number 3, checking the portfolio 20 times a day. Constant checking increases stress and triggers impulsive action. One rule, check weekly or monthly, but not hourly. Mistake number 4, mixing short-term money with long-term investments. If we might need it soon, it doesn't belong in volatile assets. That's how people get forced to sell. Mistake number 5, thinking we might outsmart the crisis. We don't need to outsmart it. We need to survive it. Survival plus consistency wins. Mistake number 6, changing the plan without changing behavior. People think new strategy fixes stress. Often the fix is a better buffer, fewer fees, a spending cap, and automation. Strategy is not a replacement for structure. What we do this week. If we want a clear plan that makes us feel in control without trading headlines, do this. Day 1, calculate essential monthly expenses and cash runway. Day 2, build or top up the starter buffer. Day 3, set autopay minimums to avoid late fees and missed payments. Day 4, confirm our target allocation, 60 and 40, 70 and 30, etc. Day 5, check if a rebalance is needed, only if meaningfully off target. Day 6, confirm automatic contributions are running. Day 7, reduce news trading by limiting market checking to one scheduled window. That's how we act in a crisis without gambling. What we do this month. If we want to use this period to actually improve our financial position, we focus on 3 upgrades. First, we increase margin. That means reducing optional spending and avoiding new monthly payments. Margin is what protects us when costs rise or income gets shaky. Second, we strengthen buffer. If we're at $0 buffer, get to $1,000. If we're at $1,000, get to 1 month of essentials. This reduces panic risk dramatically. Third, we automate investing. If we're long-term investors, automatic contributions keep us consistent and prevent waiting for a better time. These 3 upgrades matter more than guessing which sector will outperform next week. The one thing we do right now. If we want one action today, we tighten our system, not our predictions. We make sure bills are protected, the buffer is real, debt is growing, investing is automated, and rebalancing has rules. War headlines will come and go. Markets will spike, crash, and recover. The people who win aren't the ones who guess perfectly. They're the ones who avoid the big mistakes and stay consistent through the uncertainty. I'm Carlo. Thanks for watching, and remember, this is not financial advice. It's your life, your money, and your choice, whether you want to drive your wealth or park it in the driveway until it disappears.